Hey, what's going on YouTube? Welcome back. It's Travis here with JT Wealth. Now, maybe you're one of the investors out there who's a little nervous to buy the dip in the tech stocks. And if that's you, you're not alone. But in today's video, we're going to talk about 4 easy money stocks that you can buy today that don't have the same level of risk that tech stocks have, and they certainly don't carry that level of hype. So let's get into it. Alright, thanks everybody for coming back, checking out another video here on the channel. If you're new to the channel, we appreciate having you. Hopefully you find some value in today's video. If you do, guys, don't forget to take 2 seconds out of your day, smash that like button for me, and consider subscribing to the channel if you haven't already. That'll help you stay up to date with all of our recent content, and it really helps out the channel. And like I said in the intro, today's video is about 4 stocks that are being called easy money compared to just getting into the dip on the tech stocks or other things that are a little bit more risky. So we're going to touch on each of those stocks individually, talk a little bit about the company, show you guys the analyst forecast for the next 12 months for each of those stocks, as well as mention whether or not any of them have dividends that can help you grow your portfolio along with the potential growth in the price value of the stock. Alright, this article came out of MoneyWise. Jim Cramer, buying the tech dip is a mistake when these 4 stocks offer easy money. In the article, Cramer goes on to say, hey, doing the obvious thing, buying the tech dip, could cause you to miss out on these other stocks. He said he's looking instead at companies that did really good in earnings and then got unjustly trampled when the NASDAQ dropped recently because of the 43rd variant or whatever it is we're on now. He said this allows him to make sure he is buying for the fundamentals and also getting them at a lower price anytime he gets a chance to do so. Alright guys, so the first stock we're talking about today is Morgan Stanley, ticker symbol MS. Taking a look at the TipRanks site, 99.18. When I did take this image earlier in the day for the ticker symbol MS, it has 17 analysts tracking this with a moderate buy rating and a potential upside of 11.44% to $110.53 in the next 12 months. And like its financial sector peers, Morgan Stanley has a solid bull run from last November to this August. More recently, though, the shares weren't able to maintain that upward momentum. In fact, the stock is down about 10% from its August high. Now, Cramer says, I quote, "This company has done everything right during this period, but because of the inane rotation out of financials, the stock has been crushed." He points out that the investment banking giant was trading at just 12 times earnings, a very inexpensive valuation in today's market, especially compared to the high-flying tickers on the NASDAQ. And now on to the second stock in today's group, and that is Centene, ticker symbol CNC. Now, CNC was trading at about 71.19 earlier this afternoon. They have 8 analysts tracking it, another moderate buy rating, but a 14.48% potential upside in the next 12 months to an average analyst price target of $81.50. Again, you can see over on the right side, we do have some analysts pushing it as high as $93. Now, Cramer says Centene has been one of his favorite health insurers for ages. Centene stock is up 17.6% this year alone, but lags behind the S&P 500's 28.5% gain year to date. Now, Cramer does argue that because Centene mostly manages government-run health plans, it would benefit enormously from any expansion in Medicare or Medicaid, which the Biden administration supports. In the third quarter, the company's revenue grew 11% year over year to $32.4 billion. Management expects full-year revenue to come in between $125.2 and $126.4 billion. Before we move on to stock 3 and 4 of this group, it's a good time to remind you guys that all of this information is just presented for information and entertainment purposes only. I'm showcasing analysts and financial experts' opinions on these things. They're not my own personal opinions, and you should never buy anything just because you saw something on YouTube. Utilize the information to kickstart your own due diligence before you invest any of your hard-earned money. That being said, the third stock on our list is Johnson & Johnson, ticker symbol JNJ. J&J trading at 156.91 earlier this afternoon, a strong buy rating from the 6 analysts tracking this stock with a 24.28% upside potential, the highest for our 4 stocks today, to a positive price target of $195. Again, looking off to the right, you can see some analysts do rate it even higher with the high average of $215. Johnson & Johnson also has the highest dividend yield of the 4 in pack, In fact, and it has a 2.68% dividend yield. But Johnson & Johnson has pulled back from the 12%, or about 12% from its high in August, and it's recently announced a plan to split into two companies, and that didn't do too much to help its stock price. Still, Cramer likes the healthcare giant for its dividend yield, and he also points out the potential for Johnson & Johnson's pharmaceutical business after the company spins off Consumer Products Division. The pure play drug business that will be left will be the fastest growing big pharma company in the universe. It should become an instant market darling, he said. All right, and the last stock on our four today is United Parcel Service, ticker symbol UPS. UPS was trading for about $200 even earlier this afternoon. They have 15 analysts giving it a moderate buy rating and a 12.14% potential upside to an average analyst price target of $224.27. Now, e-commerce was already one of the fastest growing segments in the market, and the pandemic-induced stay-at-home environment only made online shopping even more popular. Cramer points out that freight companies like UPS are what make e-commerce possible in the first place. You simply can't get the stuff you're ordering online if somebody doesn't deliver it. Now, UPS posted solid earnings last month, and in the third quarter, consolidated revenue grew 9.2% year over year to $23.2 billion. Meanwhile, adjusted earnings per share rose 18.9% to $2.71, and management has projected a strong holiday quarter. That's got Cramer giddy. He said, "With the rails roaring, I think that UPS is now going to catch fire, a fire that burns for days, if not weeks, into the Christmas holiday." Alright guys, so those are the four stocks Cramer's looking at to buy for easy money instead of trying to buy the dip in tech, which is a little bit more risky. Now obviously, the risk to return ratio there, you have to make your own choices whether or not that's something that fits your risk profile or your portfolio goals. But nonetheless, remember, this is just to kickstart your due diligence, but pretty solid, over 10% growth potential for all four of these stocks, over 20-something% for one of them, and 3 out of the 4 having strong dividend performance. These are definitely stocks I am comfortable with, and I can see why Cramer thinks that they are easy money. But let me know in the comment section down below what you think of these 4 stocks, or whether or not you think it's more beneficial to buy the tech dip. The best part about personal finance is it's personal. So whatever you're doing, as long as it's working, keep doing it. Keep making the money, ending with those green days. Thanks so much again for checking out today's video. Hopefully you found something of value with these 4 stocks, or at least just kickstarted your imagination into how you're going to pursue your own analysis into whatever the next stock you put in your portfolio is. As always, guys, thanks so much for checking out the video. Don't forget, smash the like button. Consider subscribing if you haven't already. Leave me a comment in the comment section down below. And until next time, bottoms up.